There is a ghost in the machine of modern finance, a phantom that whispers in the ear of every investor, every chief executive, every ambitious entrepreneur. It tells you that the path to riches is paved with complexity. It insists that the greatest rewards are hidden behind layers of jargon, inside intricate spreadsheets, and within financial instruments so sophisticated that only a chosen few can truly comprehend them. This ghost sells you algorithms, derivatives, and 100-page business plans. It tells you that if you don't understand it, it must be genius, that if it feels complicated, it must be valuable. This is the great lie of our age. And for decades, one man has stood as a bulwark against this tide of needless complexity, building one of the greatest fortunes in human history on a principle so profound and so powerful that the world of high finance dismisses it as quaint, as antiquated, as folksy. That principle is simplicity. Warren Buffett, the Oracle of Omaha, has spent a lifetime proving that the most enduring success, the most powerful risk management, and the clearest path to financial freedom isn't found by embracing complexity, but by radically, ruthlessly, and relentlessly rejecting it. He understands that complexity is not a sign of sophistication, it is a sign of weakness. It is often a cloak used to hide a lack of substance, a way to charge fees for confusion, and a breeding ground for catastrophic risk. This is not just a lesson in investing. It is a lesson in thinking. It is the story of how common sense, when applied with uncommon discipline, becomes a superpower. Today, we deconstruct that superpower. We will not just admire Buffett's wisdom from a distance. We will dismantle it, piece by piece, and forge it into a tool that you can use to protect your capital, sharpen your executive decision-making, and achieve a state of mental clarity in a world that profits from your confusion. We will journey through the 5 pillars of his philosophy of simplicity, and by the end, you will understand that the most valuable promise you can make to your financial future is the final promise to keep it simple. Our first exploration into Warren Buffett's operating system for reality begins with the cornerstone of his entire investing strategy, the concept he has preached for over 50 years with unwavering consistency, the circle of competence. This isn't just a clever phrase, it's a profound rule for life and a powerful tool for risk management. It is the simple yet radical idea that you don't have to be an expert on everything. You don't need to have an opinion on every stock, every industry, every new technology. In fact, your success depends on precisely the opposite. It depends on defining the perimeter of what you know, and then having the discipline to never ever step outside of it. To understand the sheer unyielding power of this idea, we must travel back in time to the late 1990s, a period of wild euphoria and technological frenzy that came to be known as the dot-com bubble. It was a time when the old rules of business and finance were declared dead. The ghost of complexity was running rampant, whispering that profits didn't matter, that cash flow was an ancient relic, and that the only thing that mattered was a company's ability to capture eyeballs. Tech stocks, many without a single dollar of revenue, let alone profit, were soaring to astronomical valuations. Companies were adding .com to their names and watching their stock prices double overnight. It was a national mania, and at the center of it all, Wall Street and the financial media began to point a finger at the old man in Omaha. They asked, "Has Warren Buffett lost his touch?" Barron's, the influential financial weekly, ran a cover story in 1999 titled, "What's Wrong, Warren?" The article was brutal. It portrayed him as a dinosaur, a man whose simple, value-investing principles were hopelessly out of date in this brave new world of digital revolution. His company, Berkshire Hathaway, was dramatically underperforming the market. While the Nasdaq Composite Index was rocketing up 85% in 1999, Berkshire stock actually fell by 20%. The pressure was immense. Shareholders were grumbling. Pundits were mocking. Everyone, it seemed, was getting rich on companies like Pets.com, Webvan, and GeoCities, while Buffett was stubbornly holding on to his seemingly boring investments in companies like Coca-Cola, Gillette, and the Washington Post. He was invited to Sun Valley, Idaho, to speak at a conference filled with the titans of the new tech world, men like Bill Gates and Andy Grove. It was the perfect opportunity to capitulate, to admit the world had changed, to signal a new direction for Berkshire. Instead, he delivered a speech that was a masterclass in intellectual honesty and the discipline of simplicity. He didn't predict a crash. He didn't condemn technology. He simply explained his circle of competence. He laid out the history of other transformative industries, like aviation and automobiles. He showed how, in the early days, hundreds of companies competed, and while the technology itself changed the world, the vast majority of those initial investors lost everything. He admitted, with complete humility, that he had no special insight into which of the hundreds of new internet companies would be the long-term winners. He couldn't look out 10 or 20 years and confidently predict their competitive position or their earning power. He said, "I'm not going to play in a game where the other guy has an advantage." He couldn't understand their business models in the same fundamental way he understood the business model of a company that sold sugar water or razor blades. And because he couldn't understand them, he wouldn't invest. It wasn't a judgment on their potential, it was a statement of his own intellectual boundaries. This, he explained, was the core of his investing strategy. It wasn't about being smart, it was about knowing the edge of your own smarts. He returned to Omaha and continued to sit on the sidelines of the biggest party in a generation. Then, in March of 2000, the party came to a screeching halt. The bubble burst. The Nasdaq, which had peaked above 5,000, began a brutal, soul-crushing decline. Over the next 2 years, it would lose nearly 80% of its value. An estimated $5 trillion in market value evaporated. Companies that were once hailed as the future of the economy went bankrupt. The darlings of the media became punchlines. And Warren Buffett? While the tech world burned, Berkshire Hathaway's simple, understandable businesses continued to churn out cash. His focus on capital preservation, a direct result of staying within his circle, meant that while others were wiped out, he was left with a mountain of cash, ready to invest at the fire sale prices that followed the crash. The same magazine that had mocked him just months before was now hailing his genius. But it wasn't genius, it was discipline. It was the profound wealth-generating power of saying 3 simple words. I don't know. The psychological principle that underpins the circle of competence is a powerful defense against some of the most destructive cognitive biases that plague human decision-making. At its core, Buffett's strategy is a finely tuned antidote to the Dunning-Kruger effect and the overconfidence bias. The Dunning-Kruger effect, a finding from social psychology, describes a bizarre quirk of the human mind. People with low ability at a task tend to dramatically overestimate their own ability. Incompetence robs them of the metacognitive ability to realize they are incompetent. During the dot-com bubble, an entire generation of novice investors, armed with a little bit of knowledge from CNBC and a new E-Trade account, suddenly believed they were stock-picking prodigies. They mistook a tidal wave of market euphoria for their own genius. They believed they understood the new economy, but they couldn't have explained the basic principles of discounted cash flow if their lives depended on it. They were standing on the peak of what Dunning and Kruger called Mount Stupid. Warren Buffett, by contrast, operates from a position of intellectual humility. He is acutely aware of what he doesn't know. He spends his days reading and thinking, not to expand the circumference of his circle of competence by miles, but to better define its existing edge. This self-awareness is the ultimate protection against overconfidence. He knows that in the world of investing, it's not what you know that gets you into trouble, it's what you know for sure that just ain't so. The other powerful bias that Buffett circumvents is the herd bias, more commonly known today as FOMO, the fear of missing out. Human beings are social creatures, wired for conformity. When we see our neighbors and colleagues getting rich doing something, an almost irresistible psychological pressure builds to join in. During the tech bubble, this was a force of nature. Stories of secretaries becoming millionaires by investing in their company's IPO were everywhere. To sit on the sidelines felt like being a fool. It was a direct assault on one's ego and sense of financial security. The pain of missing out on perceived easy gains can often feel more acute than the pain of a potential loss. Buffett's circle of competence acts as a rational fortress against this emotional stampede. His rule is not invest where the crowd is going. His rule is invest only where I understand. Because his decision-making is anchored to an internal benchmark, his own knowledge, rather than an external one, the actions of the crowd, he is insulated from the madness. He simply doesn't allow himself to be drawn into a game where he doesn't know the rules. He is playing chess while everyone else is playing poker, and he refuses to sit at a table where he can't see the cards. This creates a kind of mental clarity that is almost impossible to achieve when your focus is on market sentiment and daily price fluctuations. It is a form of internal validation that is far more robust than the fleeting validation of the crowd. So how do you, as an investor, an entrepreneur, or a professional navigating your career, translate this powerful theory into a practical, applied mental model? You can create your own blueprint for a circle of competence by conducting what we will call a circle of competence audit. This is a step-by-step process for defining your intellectual territory and building the discipline to stay within it. Step 1 is the knowledge inventory. Take out a piece of paper or open a new document. Create 3 columns. In the first column, list your professional expertise. What industry have you worked in for years? What specific processes, customer behaviors, and economic drivers do you understand better than almost anyone? Be granular. If you're a dentist, you understand not just teeth, but the business of running a practice, the supply chains for dental equipment, the marketing channels to acquire new patients. In the second column, list your genuine, deep-seated hobbies and passions. These are the areas where you spend your free time reading, learning, and engaging. Are you a passionate homebrewer who understands the economics of craft beer? A dedicated gamer who understands the business models of video game publishers? A vintage car enthusiast who knows the market for classic parts? This is earned knowledge, just as valuable as professional experience. In the third column, list academic subjects or fields where you have formal or extensive self-taught education. Perhaps you have a degree in chemistry, or you've spent years studying military history. These are areas of foundational understanding. Step 2 is defining the edge. This is the most crucial part. For every item you listed in Step 1, you must now rigorously define the boundary of your knowledge. Ask yourself a series of tough questions. For your professional industry, what new technologies or business models threaten the status quo that you don't fully understand? For your hobby, what are the financial statements of the public companies in that space, and can you confidently read and interpret them? The goal here is not to feel bad about what you don't know, but to create a bright, clear line between competence and ignorance. Write down the questions you cannot answer. This list of unanswerable questions turns as the perimeter of your circle. Step 3 is to create your too hard pile. This concept comes directly from Buffett and Munger. Based on your audit, create an explicit, written list of industries, technologies, and types of businesses that are, for you, simply too hard to understand. Biotechnology, complex software as a service metrics, cryptocurrency protocols, speculative mining operations, whatever they are, write them down. This is your ignorance list. You will make a conscious, disciplined vow to never invest your time or serious capital in these areas, no matter how exciting the story or how much hype surrounds them. This act of conscious exclusion is liberating. It frees up your mental energy to focus only on the opportunities that fall within your defined territory. Step 4 is to go deep, not wide. Now, you focus your attention exclusively within the circles you've defined. Your job is not to find a new circle every week. Your job is to deepen your understanding of the circles you already inhabit. If you understand the dental supply business, study Henry Schein and Patterson companies. If you understand video games, do a deep dive on Take-Two Interactive and Electronic Arts. You can now analyze these businesses with a level of insight the average Wall Street analyst who covers 30 different stocks could never hope to match. You have an edge. This blueprint transforms investing from a game of frantic speculation across the entire market into a calm, focused search for value in the small patch of ground you know better than anyone else. It is the first practical step toward achieving true financial literacy and building an impenetrable defense against your own worst emotional instincts. To truly appreciate the wisdom of staying within your circle of competence, we must dedicate ourselves to understanding its antithesis, the path of the 99%. This is the road most traveled by investors, and it is littered with financial ruin. The opposite of operating within a circle of competence is not just ignorance. It is the illusion of knowledge, a phenomenon I call headline diversification. The average investor is told that diversification is the only free lunch in finance. This is true, but only to a point. What they practice is not true diversification, but a chaotic, undisciplined collection of assets based on whatever is making headlines. Their portfolio becomes a messy reflection of recent market fads. In 2017, it was buying a little bit of every cryptocurrency with a cool name. In 2020, it was piling into work-from-home stocks. In 2021, it was chasing meme stocks like GameStop and AMC, or buying into thematic ETFs like the ARK Innovation Fund at its absolute peak. They believe they are diversifying their risk, but what they are actually doing is diversifying their ignorance. They own a slice of 100 different things they do not understand. They cannot tell you the business model of the third largest holding in their favorite ETF. They cannot explain the competitive advantage of the biotech company they bought on a hot tip. This is not a strategy. It is gambling cloaked in the respectable language of personal finance. Consider the story of the average investor who, in early 2021, was consumed by FOMO. They saw Cathie Wood of ARK Invest being lauded as the next great visionary. Her funds were posting triple-digit returns by investing in disruptive innovation. The narrative was intoxicating. It was about the future, genomics, robotics, artificial intelligence. The complexity was part of the appeal. It felt like you were investing in science fiction. So the 99% investor took a large chunk of their savings and poured it into the ARKK ETF. They didn't understand the valuations of the underlying companies. They didn't read the financial statements of Tesla, Roku, or Teladoc. They were simply buying the story, outsourcing their thinking to a charismatic fund manager. They were operating miles outside their circle of competence. When the tide went out in 2022, as interest rates rose and the market turned against speculative, unprofitable tech, the results were devastating. The ARKK fund collapsed by over 67% in a single year. The 99% investor who had bought at the top saw their capital eviscerated. Panicked and confused, they sold at the bottom, locking in their catastrophic losses. They blamed the market, they blamed the Fed, they blamed Cathie Wood. But the real culprit was their own failure to adhere to the principle of simplicity. They had ventured into a territory they did not understand and paid the ultimate price. This behavior is fueled by an industry designed to exploit it. The financial media creates a constant stream of noise and urgency. Brokerage apps gamify trading with confetti and social features. The ghost of complexity whispers that you need to be in on the next big thing, that sitting still is for losers. This path of the 99% is a path of constant motion, high fees, and emotional whiplash. It is a direct consequence of ignoring Buffett's most basic rule. If you don't understand it, don't do it. The wreckage of this approach is visible in the long-term studies of investor behavior, which consistently show that the average retail investor dramatically underperforms the market itself, precisely because they buy high in moments of euphoria and sell low in moments of panic, a cycle driven entirely by stepping outside the one area where they might have had a true, sustainable edge. The financial connection between the circle of competence and your bottom line is not abstract. It is direct, quantifiable, and profound. Adhering to this principle manifests as a massive financial advantage in two key ways: the dramatic reduction of unforced errors and the preservation of compounding power. First, let's talk about unforced errors. In tennis, an unforced error is when a player misses a shot due to their own mistake, not the skill of their opponent. In investing, the majority of catastrophic losses are unforced errors. They are the result of venturing into a business or asset you don't understand and getting blindsided by a risk you never saw coming. When you invest within your circle of competence, you dramatically reduce the probability of these errors. You understand the key variables that drive the business. You know what to watch for. If you are an expert in the restaurant industry, you will pay close attention to same-store sales, commodity costs, and labor trends. You won't be surprised when a rise in beef prices hurts the margins of a steakhouse chain. A generalist investor, however, might be completely caught off guard. This intimate knowledge allows you to avoid the obvious pitfalls. You are no longer swinging at every pitch. You are waiting for the fat pitch right in your sweet spot. This discipline of avoidance is a secret weapon. Buffett himself has said, "The difference between successful people and really successful people is that really successful people say no to almost everything." By saying no to opportunities outside your circle, you are preventing the kinds of 50%, 70%, or even 90% losses that can cripple a portfolio for decades. The second, and more powerful financial connection, is the preservation of the magic of compounding. Albert Einstein supposedly called compound interest the eighth wonder of the world. The mathematical engine of compounding works best when it is uninterrupted. A steady, consistent return over a long period will produce vastly superior results to a volatile series of high gains and deep losses. A simple mathematical example illustrates this. If you start with $100,000 and lose 50% in year one, you are down to $50,000. To get back to your starting point, you now need to make a 100% gain in year two. The devastating asymmetry of loss means that the single most important factor in long-term wealth creation is not the size of your wins, but the avoidance of large losses. Staying within your circle of competence is the ultimate loss avoidance strategy. Let's quantify this with the dot-com bubble example. From the end of 1999 to the end of 2002, the technology-heavy NASDAQ 100 index fell by a staggering 75%. An investment of $100,000 became just $25,000. During that same period, Berkshire Hathaway's book value per share, a conservative measure of its intrinsic value, actually increased by 25%. The investor who chased the complex tech story saw their capital destroyed. The investor who stuck to simple, understandable businesses not only preserved their capital, but grew it. This is not a small difference. It is the chasm between financial security and financial ruin. On a balance sheet, this philosophy manifests as quality and predictability. The companies Buffett owns within his circle, like See's Candies or Nebraska Furniture Mart, have incredibly simple, resilient balance sheets. They are not loaded with debt, and their earnings are predictable. The balance sheets of the dot-com companies were fantasies, filled with goodwill from overpriced acquisitions and no real assets or earnings. The simplicity of the former leads to financial strength. The complexity of the latter was a mask for financial fragility. Ultimately, the circle of competence translates your intellectual honesty directly into financial resilience. Our second pillar of simplicity moves from the stocks you pick to the very businesses you choose to build, acquire, and operate. This is the intelligibility filter, a principle that dictates that the core business model itself must be simple, understandable, and durable. For Buffett, if he can't easily explain how a business makes money and why it will continue to make money for decades to come, it's an immediate pass. Complexity in a business model is a red flag, a sign of hidden risks and a potential lack of a true, enduring competitive advantage. The quintessential story to illustrate this pillar is the 1972 acquisition of See's Candies. This single transaction is arguably one of the most important in Berkshire Hathaway's history, not just for the money it made, but for the profound lessons it taught Buffett and his partner, Charlie Munger. At the time, Buffett was still firmly in the cigar-butt school of investing he had learned from his mentor, Benjamin Graham. He was looking for statistically cheap companies, often mediocre businesses at bargain basement prices. See's Candies was different. It was a beloved family-owned California candy company being sold by the See family. It was not statistically cheap. The family was asking for $30 million, but Buffett's initial valuation, based on its book value and assets, was much lower. He was initially inclined to walk away, But See's was a business of profound simplicity. What did it do? It made high-quality chocolates and sold them through its own retail stores. How did it make money? It sold candy for more than it cost to make. What was its competitive advantage? It had an incredibly powerful brand that was associated with quality, nostalgia, and gift-giving, particularly on holidays like Valentine's Day and Christmas. This brand loyalty gave it pricing power. Customers were not going to risk disappointing their loved ones by buying a cheaper, inferior box of chocolates. They happily paid a premium for the See's name. It was Charlie Munger who pushed Buffett to see the deeper value. He argued that it was better to buy a wonderful business at a fair price than a fair business at a wonderful price. The quality of See's, its simple, durable moat, was an asset that didn't fully appear on the balance sheet. Buffett and Munger could understand this business inside and out. It had a simple cash-based transaction model. It required very little capital investment to grow. They could envision what See's candies would look like in 10, 20, even 50 years, and it would look largely the same, still selling chocolates to loyal customers. There were no technological risks, no complex patents, no regulatory hurdles they couldn't comprehend. After some negotiation, they acquired the company for $25 million. What happened next became Berkshire legend. See's became what Buffett calls the prototype of a dream business. That initial $25 million investment required very little additional capital over the decades. Yet, it became a gusher of cash. The pricing power they identified was real. They could raise prices year after year without losing customers, and the extra profit flowed directly to the bottom line. Over the years, See's Candies has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, cash that was then used to acquire other simple, wonderful businesses. The See's experience fundamentally rewired Buffett's brain. It taught him that the simplicity of the business model itself and the durable competitive advantage it created was far more important than buying at a rock-bottom valuation. He wasn't just buying assets anymore. He was buying a perpetual, cash-generating machine that he could fully understand. This became his filter for all future acquisitions, from the Nebraska Furniture Mart to Coca-Cola. He asks a simple question: is this business easy to understand? Does it have a moat I can see and explain? If the answer is no, no matter how exciting the growth story, he moves on. He is searching for the See's Candies of the world, not the next inscrutable technology or complex financial conglomerate. The psychological principle at work here is Buffett's innate understanding of the ambiguity effect. This is a cognitive bias where people have a preference for risks that are known over risks that are unknown. We would rather choose an option with a 50% chance of a known outcome than an option where the probability of the outcome is completely uncertain, even if the latter might be mathematically superior. A complex business model is, by its very nature, a black box of unknown risks. When a company's success depends on intricate global supply chains, constantly evolving technological standards, or opaque regulatory environments, an investor is dealing with a mountain of ambiguity. You don't know what you don't know. A simple business like See's Candies is the opposite. The risks are clear and understandable: rising sugar and cocoa prices, a decline in mall foot traffic, a shift in consumer tastes. These are known variables you can analyze and manage. Buffett's intelligibility filter is a systematic process for avoiding ambiguity. He is consciously choosing the devil he knows. This provides an enormous sense of psychological comfort and allows for more rational decision-making, especially during times of market panic. When the stock market crashes, the owner of a complex, highly leveraged tech company is terrified of the unknown unknowns that could bankrupt the firm. Buffett, as the owner of a candy company, a furniture store, and an insurance company, can sleep soundly, knowing that people will still need to insure their cars, buy couches, and eat chocolate. Furthermore, this principle leverages the power of cognitive ease. Our brains are inherently lazy and prefer information that is easy to process. A simple, intelligible business model is processed with high cognitive ease. The narrative is clear, the cause and effect relationships are straightforward, and the mental effort required to analyze it is low. This isn't a sign of intellectual laziness, it's a sign of efficiency. It allows Buffett to quickly and confidently assess the merits of a business. Conversely, a business that requires a 100-page prospectus filled with jargon and complex charts to explain creates cognitive strain. This strain is a warning sign. It often indicates that the underlying reality of the business is either weak or that someone is actively trying to deceive you. The human brain's natural aversion to this strain is a protective mechanism. Buffett has simply honed this instinct into a core part of his business principles. He trusts that if a business proposition is truly good, it can and should be explained in simple terms. The need for complexity is often a confession that the core value proposition is not strong enough to stand on its own. It's the same reason a con artist uses a convoluted story. The complexity is meant to confuse the victim and prevent them from asking the simple, devastating questions that would unravel the entire scheme. How can you apply this powerful intelligibility filter to your own life, whether you're evaluating a stock, considering a job offer, or starting your own business? You can use a practical mental model called the 5-year-old explanation test. This is a simple yet profoundly effective method for cutting through complexity and getting to the heart of any business proposition. It consists of 5 simple questions you must be able to answer in language so clear that an intelligent but uninformed person, or even a hypothetical 5-year-old, could grasp the core concepts. Before you commit your capital or your career, you must pass this test. Question 1. How does this make money? You must be able to explain the fundamental transaction in 1 or 2 simple sentences. This company makes high-quality chocolate and sells it in its own stores for more than it costs to make. This company sells a subscription to software that helps small businesses manage their payroll. This company rents out construction equipment to builders. If your explanation requires words like monetization, paradigm, ecosystem, or refers to a multi-sided platform with indirect revenue streams, you have likely failed the test already. The core transaction must be crystal clear. Question 2. Why do customers choose this over the competition? This question forces you to define the competitive advantage, or moat, in simple terms. People buy this brand of soda because they have for 50 years and they love the taste. People use this search engine because it consistently gives the best results, and it's free. People shop at this grocery store because it's the only one within a 10-mile radius. If the answer is about first-mover advantage, network effects, or proprietary algorithms that you can't actually explain, be very wary. A real moat is simple to describe. Question 3. What is the single biggest thing that could kill this business? This forces you to identify the primary risk. If the price of coffee beans triples, this coffee shop chain is in big trouble. If a new technology makes their main product obsolete, this company will go bankrupt. If their key patent expires, a flood of cheap competitors will crush their profit margins. If you cannot identify a clear and primary risk, it means you don't understand the business well enough. A business with no discernible major risk is a fantasy. Question 4. If I put $1 of profit back into this business, how much value does it create? This is a simple way to think about return on invested capital. For C's Candies, the answer was very little, as it didn't need much capital to grow. This was a good thing, as it meant the profits could be used elsewhere. For a utility or a railroad, the answer is a lot, as they constantly need to reinvest. Understanding this dynamic is crucial. Finally, question 5. Can I explain all of this to someone else without them getting a confused look on their face? This is the final check. Practice your explanation on a spouse, a friend, or a colleague who is not in your industry. If their eyes glaze over, if they have to ask a dozen clarifying questions, if you find yourself resorting to jargon, you have failed the test. The business is too complex for you to have a true handle on it. This 5-step test is not about dumbing things down. It is about achieving a level of understanding so profound that you can articulate it with absolute clarity. It is a filter that protects you from seductive narratives and forces you to focus on the simple, brutal reality of how a business actually works. To fully grasp the genius of Buffett's intelligibility filter, we must examine the disastrous consequences of its opposite. The path of the 99% of corporate executives and investors is often a siren song of complexity, seduced by two of the most dangerous words in business: synergy and disruption. These concepts are used to justify enormously complex and often value-destroying business strategies. The ultimate cautionary tale of this folly is the merger of America Online, AOL, and Time Warner in the year 2000. It was, at the time, the largest merger in corporate history, a $164 billion deal that promised to create an unstoppable behemoth combining old media and new media. The narrative was intoxicating. It was a story of synergy. AOL, the king of the internet dial-up era, would provide the digital distribution for Time Warner's vast library of content, its movies, TV shows, and magazines. Time Warner would provide the premium content to flow through AOL's pipes. On paper, presented in complex slide decks by armies of investment bankers, it looked like a match made in heaven. The deal was celebrated as a visionary move, a defining moment of the new economy, but the entire premise was built on a complex and ultimately flawed understanding of how these businesses actually worked. The cultures were wildly different. The technologies were not as compatible as advertised. Most importantly, the very foundation of AOL's business, paid dial-up internet access, was about to be rendered obsolete by the rapid rise of broadband. The promised synergies never materialized. The integration was a nightmare. Instead of creating value, the merger became an anchor that dragged both companies down. The clash of cultures led to paralysis. The strategic vision proved to be a mirage. Within 2 years, the combined company was forced to report a staggering loss of nearly $99 billion, the largest annual corporate loss in U.S. history at the time. The deal is now universally regarded as one of the worst, if not the worst, merger of all time. It was a catastrophe born of complexity. The leaders involved were so enamored with a high-level, abstract story of synergy that they failed to ask the simple, grounding questions from the 5-year-old explanation test. How exactly will these two companies work together day to day? What happens to AOL's business when everyone has broadband? Is this merger actually making things simpler or more complicated for our employees and customers? They chose complexity and narrative over simple business reality. This pattern repeats itself constantly in the corporate world with vague promises of disruption. Startups raise billions of dollars on complex visions of changing the world without a simple, clear path to profitability. They promise to disrupt industries from taxis to real estate, but when you peel back the layers of jargon, you often find a business model that is simply subsidizing a product with venture capital money, with no sustainable long-term advantage. This is the antithesis of the Buffett approach. He is not looking for synergy, he is looking for standalone, excellent businesses. He is not looking for disruption, he is looking for durability. The 99% chase complex stories about the future. Buffett buys simple realities in the present. The catastrophic failure of deals like AOL Time Warner serves as a permanent, glaring reminder of the price of ignoring the profound wisdom of intelligibility. The direct financial connection between owning simple, intelligible businesses and superior financial returns is rooted in the concept of predictability. Predictability is one of the most valuable and underrated assets in business and investing. A simple business model leads to a predictable stream of earnings, and a predictable stream of earnings can be valued with a much higher degree of confidence. This confidence translates directly into a willingness to pay a higher price for the business and results in lower risk. To understand this, we need to look at Buffett's preferred metric for valuation: owner earnings. This is a concept he detailed in his 1986 shareholder letter. It's a simple, common-sense way to calculate the real cash a business generates for its owners. The formula is straightforward. Owner earnings equals a company's reported net income, plus non-cash charges like depreciation and amortization, minus the average annual amount of capital expenditures the business needs to maintain its long-term competitive position. In simple terms, it's the cash that's left over for the owners after the business has reinvested what it needs to stay healthy. For a simple business like See's Candies, calculating owner earnings is incredibly easy. You can look at its history, see how much cash it produces, and confidently project that it will produce a similar, slowly growing amount of cash next year and the year after. The business doesn't change much. The capital expenditure needs are low and predictable. Because of this clarity, you can determine its intrinsic value with a relatively small margin of error. Now, contrast that with a complex semiconductor company. Its net income can be wildly cyclical. Its depreciation schedules are complicated by rapidly changing technology. And most importantly, the amount of capital expenditure it needs just to stay competitive is enormous and unpredictable. It might need to build a new multi-billion-dollar fabrication plant every few years just to keep up. Trying to calculate true owner earnings for such a business is fraught with uncertainty. You are making guesses about future technology, competitive responses, and global demand. The range of possible outcomes is huge. Because the earnings stream of the simple business is more predictable, it is less risky. In the world of finance, lower risk commands a higher price. This is why a stable, boring utility company might trade at a higher multiple of its earnings than a volatile, speculative tech company. The market pays a premium for certainty. The financial genius of Buffett's intelligibility filter is that he systematically hunts for businesses where he can have a high degree of certainty about their future owner earnings. This allows him to value them properly and avoid overpaying. The staggering financial success of See's Candies is the ultimate proof. That $25 million investment has returned over 8,000% of its initial cost in pre-tax earnings because it was a simple, predictable cash machine. On a company's balance sheet, this simplicity manifests as clean, easy-to-read financial statements. You don't see complex derivatives, off-balance sheet entities, or convoluted debt structures. You see cash, inventory, and retained earnings. This financial clarity is a direct reflection of the operational clarity of the business model. It is a tangible sign of health, resilience, and a management team that is focused on fundamental business performance, not financial engineering. The third pillar of Buffett's philosophy of simplicity moves beyond the numbers on a page and into the realm of human interaction. It is the power of clear communication. In a world awash in corporate speak, legalese, and deliberate obfuscation, Buffett has built a multi-hundred-billion-dollar enterprise on a foundation of plain English and brutal honesty. He understands that complex language is not a tool for conveying information. It is a weapon used to conceal ignorance, hide failure, and maintain an artificial barrier between management and owners. Simplicity in communication for him is not a matter of style. It is a moral and financial imperative. The most enduring anecdote of this principle is not a single deal, but a 50-year project, the Berkshire Hathaway Annual Shareholder Letters. These letters have become legendary in the worlds of business and finance, required reading for anyone serious about investing. But their power does not come from complex financial analysis or brilliant stock tips. Their power comes from their radical, almost shocking, simplicity and clarity. To understand their impact, you must contrast them with a typical corporate annual report. A standard report is an impenetrable document, written by lawyers and accountants for lawyers and accountants. It is filled with jargon, boilerplate warnings, and financial tables so dense they are functionally useless to the average person. It is designed not to inform but to indemnify the company against lawsuits. Buffett's letters are the polar opposite. They are written as a conversation between partners. He writes them himself, and he has a specific person in mind when he does: his sister, Doris, an intelligent woman who is not a financial expert. If she can't understand a sentence, he rewrites it. This simple filter forces him to translate the complex world of insurance, finance, and acquisitions into language anyone can understand. For example, he has spent decades explaining the concept of insurance float, the cash that an insurance company holds between collecting premiums and paying claims, which is a core engine of Berkshire's success. A textbook would define it with complex actuarial terms. Buffett explains it with a simple analogy. He calls it a no-cost, long-term loan from policyholders that he gets to invest for Berkshire's benefit. He explains that as long as they underwrite insurance policies at a profit, the cost of this loan is actually less than zero. In a few simple sentences, he makes a complex financial concept intuitive and clear, but his commitment to clarity goes even deeper. It extends to a radical honesty about his own mistakes. In his 1999 letter, written at the height of the dot-com bubble when he was being pilloried by the press, he didn't make excuses. He openly discussed his mistake of omission in not understanding the tech sector. In other letters, he has detailed his mistakes of commission, acquisitions that went poorly, with a candor that is unheard of in the C-suite. He once wrote, "I will tell you what I would say to my family today if they asked me about Berkshire's future." This framing is revolutionary. It tears down the wall between the CEO and the shareholder. It transforms the relationship from a formal, adversarial one into one of trust and partnership. This decades-long commitment to clear, simple, and honest communication has created a shareholder base that is unlike any other in the world. They are long-term, patient, and deeply loyal. They trust him not because he is infallible, but because he is honest. When a crisis hits, Berkshire shareholders don't panic and sell. They trust that Warren will explain the situation to them clearly and manage the company through it. This trust, built word by simple word over half a century, is one of Berkshire Hathaway's most valuable and least tangible assets. The psychological principle that makes Buffett's communication style so effective is his intuitive grasp of how to overcome the curse of knowledge. This is a cognitive bias that afflicts experts in every field. When you know something deeply, it becomes incredibly difficult to imagine what it's like not to know it. You unconsciously assume that the terms, concepts, and relationships that are obvious to you are equally obvious to others. This leads to experts speaking in jargon, failing to explain basic assumptions, and ultimately, failing to communicate their ideas effectively. Doctors who can't explain a diagnosis in plain English, engineers who overwhelm clients with technical specifications, and CEOs who speak in convoluted business jargon are all victims of this curse. Buffett actively and deliberately fights it by using his sister as a mental proxy for his audience. This simple technique forces him to step outside his own expert brain and adopt the perspective of a novice. It is an act of empathy that is at the heart of all great communication and leadership. By writing for a specific, intelligent, non-expert, he systematically dismantles the curse of knowledge, ensuring his message is not just transmitted, but truly received and understood. Beyond this, Buffett's style masterfully leverages the psychological principles of liking and reciprocity. The liking principle, identified by psychologist Robert Cialdini, states that we are more likely to be influenced by people we like. Buffett's folksy humor, his self-deprecating admissions of error, and his direct, unpretentious language make him incredibly likable. He doesn't sound like a remote, all-powerful CEO. He sounds like a wise, trustworthy grandfather. This personal connection builds a deep reservoir of goodwill. The principle of reciprocity suggests that we feel an obligation to give back to others the form of behavior they have first given to us. By being extraordinarily candid and transparent with his shareholders, treating them as true partners, Buffett triggers a reciprocal sense of loyalty and partnership in them. He gives them the gift of clarity and honesty, and in return they give him the gift of their long-term, patient capital. This is a stark contrast to the typical corporate relationship, which is often transactional and adversarial. When a company communicates in opaque legalese, it signals distrust of its own shareholders. In response, shareholders behave like short-term traders, ready to dump the stock at the first sign of trouble. Buffett's communication strategy is therefore not just a matter of good writing, It is a sophisticated form of psychological engineering, designed to build the most stable and loyal shareholder base in the world. It's a demonstration that in the long run, transparency and trust are far more powerful than complexity and control. How can you harness the immense power of clear communication in your own professional and personal life? You can adopt a powerful framework I call the annual letter practice. This is a direct application of Buffett's method, scaled to your own circle of influence. It is a tool for building trust, creating alignment, and forcing yourself to think with greater clarity. It's a simple, repeatable process. Step 1. Identify your key stakeholders. Who are the most important people whose trust and alignment are critical to your success? At work, this could be your direct reports, your boss, or a key client. In your personal life, it could be your spouse or your family. For an entrepreneur, it is your investors and your employees. Choose a small, critical group. Step 2. Commit to a regular cadence. Just like Buffett's annual letter, the power of this practice comes from consistency. Commit to writing a letter to your stakeholders once a year, or perhaps once a quarter. Put it on the calendar. This is not a casual email update. It is a thoughtful, deliberate piece of communication. Step 3. Follow the Buffett structure. Your letter should have 3 simple, honest sections. The first section is what we said we would do. Look back at your last letter, or the beginning of the period. What were the goals? What were the promises made? State them simply and directly. This creates accountability. The second section is what we actually did. This is where the magic happens. Detail the results, both good and bad. If you succeeded, explain why. More importantly, if you failed or fell short, admit it openly and take responsibility. Analyze the mistake. What did you learn? How will you prevent it from happening again? This is the part that builds incredible trust. Vulnerability and honesty are magnetic. The third section is what we plan to do next. Based on the results and the lessons learned, lay out a clear, simple plan for the next period. Avoid vague promises. Focus on a few key priorities and explain why they are important. This provides clarity and a shared sense of purpose. Step 4. Write like a human. This is the most important rule. Banish all jargon, acronyms, and corporate speak. Use simple sentences. Tell stories. Use analogies, just as Buffett does with insurance float. Read your letter out loud. Does it sound like something a real person would say in a conversation? If not, rewrite it. Imagine you are writing to a specific, intelligent person you respect, like your sister, a parent, or a trusted mentor. This practice, performed consistently over time, will have a transformative effect. For a leader, it will align your team and build a culture of trust and accountability. For an entrepreneur, it will create loyal investors who stick with you through the tough times. In your personal life, it will foster deeper, more honest relationships. It forces you to simplify your own thinking, to admit your own failures, and to communicate your intentions with a clarity that is as rare as it is powerful. The antithesis to Buffett's philosophy of clear communication is the pervasive and toxic culture of corporate speak. This is the path of the 99% of managers, leaders, and public figures. It is a mangled, pseudo-intellectual dialect of English designed not to communicate, but to obfuscate, to impress, and to evade responsibility. It is the language of complexity used as a shield. You've heard this language everywhere. It's in press releases that announce layoffs not as firing people, but as right-sizing the organization to optimize core competencies. It's in business plans that don't talk about making a product and selling it, but about, quote, leveraging synergistic platforms to create value-added B2B solutions. It's in the politician's apology that isn't an apology at all, but a statement that mistakes were made. This language is a virus that infects clear thinking. When a manager says they are reaching out to circle back and touch base, they are using 10 words to say what could be said in one. Talk. This isn't just inefficient, it's a symptom of a deeper problem. it often indicates a lack of clear thought. People who can't explain their ideas in simple terms often haven't fully understood the ideas themselves. They are using complex language as a smokescreen to hide the fact that they have nothing meaningful to say. The most sinister application of this obfuscation is in hiding failure and wrongdoing. The most horrifying case study in modern history is the Enron scandal. Enron was an energy trading company that for a time was one of the most admired companies in America. But its success was a complete fabrication, hidden behind a fortress of impenetrable complexity. Its financial statements were gibberish. They created thousands of special-purpose entities, off-balance sheet partnerships designed to hide massive amounts of debt and inflate earnings. The names of these entities were themselves a form of corporate speak, with names like Raptors and Jedi. When analysts on conference calls would ask simple, direct questions to then CEO Jeffrey Skilling about how Enron actually made money, he would respond with aggressive, jargon-filled tirades, or famously, call the analyst an asshole. This was not the language of a confident leader of a healthy business, it was the language of a fraudster, using complexity and aggression as a defense mechanism. The leaders of Enron used the language of the 99% to an extreme degree, and it enabled them to commit one of the largest corporate frauds in history, destroying the life savings of thousands of their own employees and shareholders. This is the dark side of complexity in communication. It is a tool for deception. When you encounter a leader, a company, or a financial advisor who cannot explain their strategy in simple, clear terms, your alarm bells should ring. It is a massive red flag. They are either incompetent, meaning they don't understand it themselves, or they are malicious, meaning they don't want you to understand it. In either case, the only rational response is the one Buffett would have: walk away. The direct financial connection between clear communication and business success is tangible and can be measured in a lower cost of capital. Capital is the lifeblood of any business, and the cost of capital is the return that investors and lenders demand for providing it. This cost is not fixed. It is heavily influenced by the perceived risk of the enterprise. A riskier business has to pay more to attract investment. And one of the biggest risks in any business is management risk. The risk that the people running the show are incompetent, dishonest, or both. Clear, simple, and honest communication, practiced consistently over time, directly lowers this perceived risk. This creates what you could call a trust premium on the company's valuation. Think of two identical companies. Company A is run by a CEO who communicates like Warren Buffett. Their annual reports are clear, they admit mistakes, and they lay out a simple, understandable strategy. Company B is run by a typical CEO. Their reports are filled with jargon, they spin bad news, and their strategy is described in vague, aspirational terms. Which company would you rather invest in? Which company's stock would you be more willing to hold through a market downturn? The rational choice is Company A. You trust the management. Because investors are more willing to invest in Company A and are less likely to sell in a panic, its stock will be more stable and will likely trade at a higher valuation multiple than Company B. This stability and premium valuation mean that when Company A needs to raise money by issuing new stock or debt, it can do so on more favorable terms. Its cost of capital is lower. This is not a theoretical benefit. It is a powerful, compounding competitive advantage. Berkshire Hathaway itself is the ultimate example. It has one of the most stable long-term shareholder bases on Earth. This allows Buffett to make long-term decisions without worrying about short-term market reactions. This patient capital is a direct result of the trust he has built through decades of clear communication. On a corporate income statement, this translates into lower interest expenses on debt. On a balance sheet, it translates into a stronger equity base. The trust premium is a real financial asset, built not with financial engineering, but with the simple, powerful tools of honesty and plain English. It is proof that in the world of business, clarity is not just kind, it is incredibly profitable. We now arrive at the fourth pillar of Buffett's philosophy of simplicity, and it is perhaps his most vehement, the total and utter rejection of what he calls financial alchemy. This is his deep-seated skepticism of financial innovation, exotic instruments, and the excessive use of leverage. While Wall Street is a factory for creating new, complex products that promise to enhance returns or reduce risk, Buffett views these inventions with extreme prejudice. He understands that this complexity is rarely designed to benefit the customer. It is designed to generate fees for the institution and often serves to conceal rather than mitigate enormous, unseen risks. His most famous pronouncement on the subject came in his 2002 shareholder letter, where he referred to derivatives as financial weapons of mass destruction. The story that perfectly encapsulates his thinking on this subject is his experience with the near collapse of long-term capital management, or LTCM, in 1998. The tale of LTCM is the ultimate hubris meets nemesis story of modern finance. The hedge fund was a supernova of intellectual firepower. Its partners included John Meriwether, the legendary bond trader from Salomon Brothers, and most notably two Nobel Prize-winning economists, Myron Scholes and Robert C. Merton, the creators of the famous Black-Scholes options pricing model. They were, without exaggeration, considered the smartest guys in any room. Their strategy was the epitome of complexity. They used incredibly sophisticated quantitative models to identify tiny, temporary pricing discrepancies in global bond markets. They would then use enormous amounts of leverage, borrowed money, to turn these tiny discrepancies into significant profits. At its peak, the fund had about $5 billion of its own capital but had borrowed over $125 billion and had off-balance sheet derivative positions with a notional value of over $1.25 trillion. The complexity was breathtaking. Their trades were so intricate that even their own investors had only a vague idea of what the fund was actually doing. For a few years, it worked like magic. They generated returns of over 40% annually. The world was in awe. Then, in August 1998, a black swan event occurred. Russia defaulted on its government debt. This was an event that their complex models had suggested was virtually impossible. But it happened. The event triggered a global flight to safety, causing the pricing discrepancies that LTCM was betting on to widen dramatically instead of converging. Their models broke. With the immense leverage they were using, their losses were catastrophic. In a matter of weeks, the fund lost over $4.6 billion and was on the brink of collapse. Because they were so interconnected with every major bank on Wall Street, their failure threatened to trigger a chain reaction that could bring down the entire global financial system. The Federal Reserve Bank of New York was forced to intervene, orchestrating a massive $3.6 billion bailout by a consortium of major banks. Warren Buffett was called in. He was asked to consider participating. He flew to New York and met with the key players. He listened to their explanations. But his simple, common-sense questions cut through the intellectual fog. He couldn't get a straight answer on exactly what the full exposure was. The geniuses who had built the machine could no longer control it. He saw the core of the problem with blinding clarity. As he later said, to make money they didn't have and didn't need, they risked what they did have and did need. That is foolish. He ultimately offered to buy out the entire portfolio for a ridiculously low price on his own terms, an offer that was rejected. But his diagnosis of the situation was perfect. A group of geniuses, blinded by the elegance of their own complex models, had taken on an insane level of risk that was hidden from view until it was too late. For Buffett, LTCM was the ultimate proof that complexity, combined with leverage, is a recipe for disaster. It was a lesson he would never forget. The psychological biases that led to the LTCM disaster are a clinic in human folly. The primary driver was the authority bias. The entire financial world, from investors to regulators, was so dazzled by the credentials of LTCM's partners, especially the Nobel laureates, that they suspended their critical judgment. The thinking was, if these geniuses are doing it, it must be safe. Who am I to question a Nobel Prize winner? This deference to authority led to a complete failure of due diligence. People handed over their money without truly understanding the risks, simply because they were intimidated by the intellectual prestige of the firm's founders. Buffett, whose entire philosophy is built on independent thought, is almost immune to this bias. He doesn't care about credentials. He cares about whether the business makes sense. He would rather invest in a company run by a high school dropout who understands the simple economics of the furniture business than a hedge fund run by PhDs with a strategy he can't comprehend. The second powerful bias at play was confirmation bias. For the first few years, LTCM's strategy worked brilliantly. Every successful trade, every year of 40% returns, served as powerful confirmation that their complex models were correct and infallible. This string of successes made the partners and their investors increasingly blind to the possibility of failure. They started to believe their own hype. They searched for and interpreted new information in a way that confirmed their pre-existing belief in their own genius. Any data that contradicted their models was dismissed as an anomaly. This is a classic trap for highly intelligent people who can use their brainpower to construct ever more elaborate rationalizations for why they are right, rather than questioning their fundamental assumptions. Buffett's approach of simplicity is a direct countermeasure. By focusing on simple, time-tested business principles, he avoids getting seduced by new, unproven models. His confirmation bias works in his favor. He looks for evidence that a business has a simple, durable, competitive advantage, a characteristic that has proven its worth over a century of capitalism, not just a few years of a bull market. The entire saga of LTCM is a testament to the idea that high IQ and complex strategies are no match for common sense and a deep understanding of human psychology. As Buffett's partner Charlie Munger is fond of saying, "It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, instead of trying to be very intelligent." How can you protect yourself from the seductive allure of financial alchemy and the risks of hidden complexity? You can employ a powerful mental model that Charlie Munger evangelized. Invert, always invert. Instead of asking how a particular investment or business strategy can succeed, you must rigorously and systematically ask how it can fail. This simple flip in perspective is a powerful tool for risk management and for cutting through complexity. Let's create a blueprint for this inversion risk assessment. Step 1. Clearly identify the complex proposition. This could be anything from a new investment product your advisor is pitching, like a structured note or a non-traded REIT, to a complex business strategy you are considering, like a major technological pivot or a heavily leveraged acquisition. Write it down in a single sentence. For example, I am considering investing in a highly leveraged cryptocurrency arbitrage fund that promises 20% annual returns. Step 2. Brainstorm every possible failure point. This is the core of the inversion exercise. Instead of thinking about the upside, focus exclusively on the downside. How could this go to zero? What are all the ways you could suffer a permanent loss of capital? Don't just think about market risk. Think about every kind of risk. For our crypto fund example, the list might look like this. The arbitrage opportunity could disappear as more players enter the market. The exchange where the assets are held could get hacked. The fund managers could be fraudulent. A key person in the fund could leave. Regulatory changes could make the strategy illegal. A flaw in the smart contract could be exploited. A flash crash could trigger a cascade of liquidations due to the high leverage. Be brutally pessimistic. List at least 10 potential points of catastrophic failure. Step 3. Assess your own understanding. Now look at your list of failure points. For each one, ask yourself, do I fully understand how this works and how likely it is to occur? With the LTCM example, very few, if any, of their investors could have identified and understood the risk of a Russian debt default and how it would ripple through their portfolio. If you look at your list and realize that half of the failure points involve technology or financial structures you don't really comprehend, that is your answer. You have identified a fatal level of ambiguity. The inversion process has revealed that you do not have the competence to properly assess the risk. Step 4. The one-sentence kill switch. If, after this process, you cannot summarize the single greatest risk to the venture, In one simple, clear sentence that you could explain to a spouse or a friend, you must kill the idea. For LTCM, the sentence would have been, the entire fund could be wiped out by a single, unexpected global event because we are using an insane amount of borrowed money. If you can't articulate the kill switch, it means the complexity is successfully hiding the true danger from you. This inversion process is a powerful antidote to the optimism and overconfidence that complex propositions are designed to create. It forces you to become a pessimist first, a risk manager second, and an investor third. It is a simple, systematic way to avoid blowing up, which, as we've learned, is the first and most important rule of achieving financial freedom. To fully comprehend the wisdom of rejecting financial alchemy, we must look at the path of the 99%, which leads directly into the heart of the 2008 global financial crisis. The crisis was not an accident. It was a direct consequence of a financial system that had embraced complexity as its core operating principle. It was the LTCM crisis on a global, society-shattering scale. At the center of the storm were financial instruments of mind-numbing complexity, most notably the collateralized debt obligation, or CDO. The story of the CDO is a masterclass in how complexity can be used to disguise garbage as gold. It worked like this. Banks would issue thousands of risky, subprime mortgages to homebuyers with poor credit. Individually, these mortgages were clearly toxic. But then the financial alchemists on Wall Street got to work. They would take thousands of these bad mortgages and bundle them together into a pool. The theory was that by diversifying across many mortgages, the risk would be reduced. Then, they would slice this pool into different pieces, or, quote, tranches. The top tranches got paid first from the mortgage payments coming in, making them supposedly super safe. The bottom tranches got paid last, making them super risky. The genius and fraudulent part of the scheme was that the credit rating agencies, who were paid by the banks creating the CDOs, would then stamp the top tranches with a AAA rating, the same safety rating as a U.S. government bond. This was the alchemy, turning lead, subprime mortgages, into gold, AAA-rated securities. But it didn't stop there. The complexity went into overdrive. Wall Street then created CDOs squared, which were CDOs made up not of mortgages, but of slices of other CDOs. It was a house of cards built on a house of cards. And then came the credit default swaps, CDS, which were essentially insurance policies on these CDOs, creating a whole new layer of interconnected risk. The result was a system so complex that almost no one involved truly understood it. The mortgage brokers didn't understand the loans they were pushing. The home buyers didn't understand the adjustable rate terms. The investment bankers creating the CDOs didn't understand the true risk of the underlying assets. The investors buying the AAA-rated tranches didn't understand that they were filled with junk. And the regulators had no idea how to supervise it all. It was a global conspiracy of willful ignorance, all greased by the immense fees being generated by the creation and sale of these complex products. When the inevitable happened, when homeowners started defaulting on their unaffordable mortgages, the entire system collapsed. The safe AAA-rated securities turned out to be worthless. The insurance companies that had written the CDS policies couldn't pay. Major financial institutions like Lehman Brothers went bankrupt. The crisis plunged the world into the worst recession since the Great Depression. This was the ultimate price of the 99% path. It was a world that Buffett had warned about for years. He had avoided these complex instruments, keeping Berkshire's balance sheet simple and clean. While the rest of the financial world was playing with weapons of mass destruction, he was sticking to insurance, railroads, and Coca-Cola. His rejection of financial alchemy wasn't a missed opportunity. It was the very thing that allowed him to not only survive the crisis, but to emerge from it stronger than ever, providing capital to sound but panicked companies like Goldman Sachs and Bank of America on incredibly favorable terms. The direct financial connection between rejecting complexity and building a resilient fortune lies in understanding the lethal asymmetry of leverage and the fragility it creates. A balance sheet is a snapshot of a company's financial health. A simple, strong balance sheet like Berkshire Hathaway's is a fortress. It has minimal debt, a huge pile of cash and liquid securities, and its assets are real, understandable businesses. This fortress balance sheet gives it immense resilience and optionality. During a crisis, when credit markets freeze and weaker competitors are struggling to survive, Berkshire can act. It becomes the lender of last resort, the buyer of distressed assets, the stable force in a world of panic. This is a direct financial advantage. Now consider the balance sheet of a highly leveraged investment bank before the 2008 crisis. It was a labyrinth of complexity. It was loaded with debt, often leveraged 30 to 1, meaning for every dollar of their own capital, they had borrowed $30. Its assets were not simple businesses, but trillions of dollars in opaque, Level 3 assets like CDOs, whose value was not based on market prices but on the bank's own internal models. This complexity created extreme fragility. A tiny decline in the value of their assets could wipe out their entire capital base. This is the dangerous asymmetry of leverage. The upside is capped, but the downside is ruin. If you are leveraged 30 to 1 and your assets increase in value by 3%, you've doubled your money. But if your assets fall in value by just 3.3%, your entire capital is gone, you are bankrupt. The complexity of the CDOs and other derivatives served to hide this fragility. It made the assets seem safer than they were, justifying the use of more and more leverage. This is why Buffett is so averse to debt and complexity in Berkshire's financial structure. He understands that financial success is not about maximizing returns in any given year. It is about ensuring you can survive to play the game for many years to come. Survival is the prerequisite for compounding. The 2008 crisis revealed the truth in stark, financial terms. The complex, fragile balance sheets of companies like Lehman Brothers and Bear Stearns shattered. The simple, fortress balance sheet of Berkshire Hathaway not only endured, but was able to deploy its capital at a time of maximum opportunity, buying stakes in America's best companies at once-in-a-generation prices. This is the ultimate financial payoff of simplicity. It transforms a company from a fragile house of cards into an anti-fragile institution that actually gets stronger from chaos. It is the difference between a structure designed to generate short-term fees and one designed for multi-generational survival and prosperity. We have now arrived at the fifth and final pillar, the philosophical core that underpins all the others. This is the mental model of focusing on first principles. This is the ultimate act of simplification. It is the practice of boiling down any complex problem or situation to its fundamental, undeniable truths, and then reasoning up from there. Instead of relying on conventional wisdom, analogy, or what others are doing, first principles thinking requires you to build your own understanding from the ground up. Warren Buffett is a master of this. While the world of finance is obsessed with complex econometric models, technical chart patterns, and fleeting market narratives, Buffett's entire process is a relentless application of a few simple first-principle questions. Is this a good business? Is it run by honest and able people? And is it available at a sensible price? The story that best illustrates this powerful approach is his investment in the Washington Post Company in the early 1970s. In 1973, the stock market was in a brutal bear market. On top of that, newspaper stocks were deeply out of favor. The conventional wisdom, the narrative being pushed by Wall Street, was that newspapers were a dying business, threatened by the rise of television news. The stock prices of even the best newspaper companies were getting crushed. The Washington Post itself, fresh off its legendary Watergate reporting, saw its stock price plummet. The entire company had a market valuation of about $80 million. This is where the 99% of investors stopped. They heard the narrative, newspapers are dead, saw the price action down, and concluded it was a bad investment. They reasoned by analogy. This is like investing in horse-drawn carriages after the automobile was invented. Buffett, however, ignored the narrative completely and went back to first principles. He started asking fundamental questions. Question 1. What is the fundamental business here, stripped of all the noise? He realized that a dominant newspaper in a major city was not just a newspaper. It was an information monopoly. In an era before the internet, if you were a business in Washington, D.C., and you wanted to advertise your products, or if you were a citizen and wanted to find a job or an apartment, you had to use the Washington Post. There was no viable alternative. This gave it immense, non-negotiable pricing power. Question 2. Does this business have a durable competitive advantage? The answer was a resounding yes. The brand was iconic, especially after Watergate. The distribution network was unmatched. A new competitor would have to spend a fortune to even attempt to replicate its infrastructure and its readership. It had a deep, wide moat. Question 3. What are the actual assets of this company? He did something the rest of the market wasn't doing. He looked past the newspaper label and did a simple, piece-by-piece valuation of the company's holdings. He realized the Washington Post company also owned Newsweek magazine, several highly profitable television stations in major markets, and other assets. Buffett, being a simple but brilliant analyst, did the math. He calculated that the television stations alone were worth more than the entire $80 million market capitalization of the company. The other assets, including the world-famous newspaper itself, were essentially being thrown in for free. So to recap the first principles analysis, the market was selling him a share in an information monopoly with a durable competitive advantage, which owned a collection of assets worth at least $400 million for a total price of just $80 million. He was being offered the chance to buy a dollar for 20 cents. He ignored the noise, ignored the narrative, and, over the course of 1973, invested over $10 million, becoming one of the company's largest shareholders. That investment would go on to be one of his most successful, growing over 100 times in value over the next 30 years. This was not the result of a complex algorithm or inside information. It was the result of a simple, repeatable process of dismantling a situation down to its fundamental truths and acting rationally on those truths, completely independent of the prevailing opinion of the crowd. The psychological power of first principles thinking lies in its ability to act as a shield against the most pervasive and lazy of our cognitive shortcuts. Specifically, it is a direct antidote to the availability heuristic and the narrative fallacy. The availability heuristic is our mental tendency to overestimate the importance of information that is easily available to us. In the 1970s, the readily available information was all negative. A bad stock market, the rise of television, and bearish reports from Wall Street analysts. This information created a vivid, easily recalled story that, quote, newspapers are doomed. When we rely on this heuristic, we are essentially outsourcing our thinking to whatever is recent, dramatic, and easily accessible. We are letting the headlines on the front page dictate our deep-seated conclusions. First principles thinking is the act of deliberately rejecting this easy, available information and undertaking the harder work of finding the fundamental, underlying data. Buffett didn't care about the latest analyst report. He cared about the unchangeable fact of the Washington Post's monopolistic position in its market. He chose the difficult, foundational truth over the easy, available narrative. This leads directly to the narrative fallacy, a term coined by Nassim Nicholas Taleb. This fallacy describes our love of stories and our tendency to cram complex, messy realities into simple, coherent narratives. The story of old media being replaced by new media was a simple, compelling, and ultimately wrong narrative in the 1970s. Once a narrative takes hold, we tend to filter all new information through it, looking for evidence that confirms the story and ignoring evidence that contradicts it. First principles thinking is a narrative-destroying machine. It forces you to question the very premise of the story. By asking, what is a newspaper business really? Buffett was breaking the narrative apart. He wasn't seeing a story of decline. He was seeing the factual reality of a subscription and advertising business with a powerful local moat. This is an incredibly difficult mental discipline. It requires a willingness to look foolish in the short term, to stand apart from the crowd, and to trust your own analysis over the comfort of consensus. It is a conscious choice to engage in slow, deliberate, effortful thinking, what psychologist Daniel Kahneman calls system 2 inches thinking, rather than the fast, intuitive, and often wrong thinking, system 1 inch, that governs most of our decisions. By building his worldview from the ground up, based on unchanging principles of business and human nature, Buffett insulates himself from the fads, manias, and popular delusions that sweep through the market. How can you integrate this ultimate simplification tool into your own decision-making process? You can use a structured method of inquiry, known as the Socratic questioning method. Named after the classical Greek philosopher Socrates, this method is about using disciplined, probing questions to get to the truth of a matter, rather than accepting superficial assertions. It's a blueprint for thinking for yourself. Step 1. Identify a core belief or a complex problem. Start with a piece of conventional wisdom or a complex decision you are facing. For example, to build wealth in the 2020s, I must have a significant portion of my portfolio invested in artificial intelligence stocks. This is a common narrative today, just like newspapers are dead was in the 1970s. Step 2. Deconstruct the assertion with foundational questions. Now you begin to question every part of that statement, as if you know nothing. You are not looking for opinions, you are looking for facts. Stumps, what, precisely, is artificial intelligence? Can I define it simply? Is it a product, a service, or a component of other products? Asterisk. What is the fundamental business model of these so-called AI companies? Are they selling software subscriptions? Are they selling specialized computer chips? Are they selling consulting services? How, specifically, does money go from a customer's pocket into their bank account? Times. What is the actual tangible moat of these companies? Is it a technological advantage? If so, how long will it last before a competitor copies it? Is it a brand? Is it a network effect? Be specific. They have smart people is not a moat. Times. Why is this a good business independent times of the AI label? If you removed the buzzword, would you still be interested in a company that sells enterprise software or designs semiconductors? This question strips away the hype and forces you to analyze the underlying business. Step 3. Continue questioning until you reach bedrock. For every answer you generate, ask why, or how do I know that's true, like a relentless child. If a company claims a technological advantage, ask, how is it protected? Patents? Trade secrets? How defensible is it? If the answer is about having the most data, ask, is that data truly proprietary and a source of long-term advantage, or can it be replicated? The goal is to keep drilling down until you are left with simple, verifiable facts, and you have exposed all the underlying assumptions you were unconsciously making. You might discover that the company you thought was an AI company is actually just a low-margin consulting firm that uses the AI label as a marketing gimmick. Or you might discover a company with a truly defensible position. The outcome doesn't matter. The process is what builds true understanding. This Socratic method is a universal acid for complexity and hype. It can be applied to any business decision, any investment thesis, any career choice. It is a slow, disciplined, and sometimes uncomfortable process, but it is the only known antidote to outsourcing your judgment to the crowd. It is the path to forming an opinion that is truly your own. To see the staggering power of first principles thinking, we need only look at the graveyard of investment trends that were fueled by its antithesis, chasing the narrative. This is the path of the 99% of investors, and it is a reliable road to disappointment. Investing based on a popular story, rather than on a sober analysis of underlying business fundamentals, is one of the most common and destructive mistakes in finance. History is littered with examples. In the late 1960s and early 70s, it was the Nifty 50, a group of large-cap stocks like Polaroid, Xerox, and IBM that were considered so good, so dominant, that you could buy them at any price. They were one-decision stocks, The narrative was that these were America's greatest companies, and you could never overpay for quality. Investors who bought into this story at the peak in 1972 paid valuations of 50, 80, or even 100 times earnings. When the bear market of 1973-74 hit, these can't-lose stocks collapsed, falling 50 to 80% and staying down for a decade. The narrative was great. The price paid for it was insane. In the late 1990s, the narrative was the internet, a story so powerful it led people to invest in companies with no revenue, let alone profits, like Pets.com. The story of a new paradigm was used to justify abandoning the first principles of business valuation entirely. The result was a historic crash. In the 2010s, we saw a series of smaller narrative bubbles. There was the 3D printing craze, where a compelling story about a manufacturing revolution led to absurd valuations for companies that never achieved mainstream profitability. There was the cannabis stock boom, driven by a simple narrative of legalization where investors piled into companies with poor economics and intense competition. Most recently, we've seen narratives around the metaverse, where billions were invested in a vision of the future that had no clear business model or path to widespread adoption. In every single one of these cases, the 99% of investors did the same thing. They fell in love with the story. They bought the hype. They were reasoning by analogy. This is the next Amazon, instead of from first principles. They did not ask the hard, simple questions about profitability, competition, and valuation. Chasing the narrative feels exciting. It feels like you are part of the future. It provides the social comfort of being in the crowd, but it is an abdication of the hard work of thinking. It is allowing your financial decisions to be driven by emotion and storytelling rather than by logic and analysis. Buffett's entire career is a testament to the opposite approach. He ignores the stories and focuses on the facts. While others are chasing the next hot narrative, he is patiently analyzing the simple economics of businesses that have stood the test of time. This is why he has been able to avoid every major speculative bubble of the last 50 years. His commitment to first principles is his ultimate defense against the madness of crowds. The final, direct financial connection of this entire philosophy of simplicity, and specifically of first principles thinking, is the concept that sits at the very heart of value investing, the margin of safety. This principle, first taught to Buffett by his mentor Benjamin Graham, is the ultimate financial manifestation of intellectual honesty and the bedrock of all successful risk management. The idea itself is incredibly simple. First, you use your analysis, your first principles thinking, to determine the fundamental, intrinsic value of a business. This is your best estimate of what the business is truly worth, independent of its fluctuating stock price. Then, you patiently wait until you can buy that business at a significant discount to that calculated intrinsic value. That discount is your margin of safety. It is your protection against the uncertainties of the future. It's your cushion against errors in your own judgment, against bad luck, against a downturn in the economy. It is the financial outcome of humility. When Buffett analyzed the Washington Post and concluded its assets were worth at least $400 million, that was his calculation of intrinsic value. When he was able to buy into the company at a market valuation of just $80 million, he was getting a massive margin of safety. Even if his valuation was wildly optimistic, even if he was off by 50%, he would still be buying the business for half of its true worth. This is what transforms investing from a speculative gamble into a disciplined, wealth-building enterprise. A simple, understandable business, one that passes the intelligibility filter, allows for a much more confident and reliable calculation of intrinsic value. It's far easier to estimate the long-term owner earnings of See's Candies than it is for a speculative biotech firm. Therefore, a simple business allows for the creation of a more robust and meaningful margin of safety. Complexity and a margin of safety are enemies. The more complex and uncertain a business is, the more impossible it is to confidently calculate its intrinsic value, and thus, the concept of a margin of safety becomes meaningless. You are simply guessing. On a personal balance sheet, the margin of safety is what separates true wealth from a precarious lifestyle. It is having cash reserves. It is having low or no debt. It is having an earnings power that far exceeds your expenses. It is a buffer against the inevitable shocks and setbacks of life. This principle of simplicity, from the circle of competence to first principles thinking, is a unified system for building that buffer. It guides you to avoid businesses you don't understand, to reject complex and fragile financial structures, and to only act when the odds are overwhelmingly in your favor. It is a slow, patient, and disciplined path. It doesn't promise quick riches. It promises something far more valuable: resilience, clarity, and the quiet, compounding power of common sense. It is the final promise that enduring success is not found in the complex illusion of genius, but in the simple, bedrock reality of value. You have just spent this time investing in a mental tool of immense power. You have absorbed an entire operating system for thought, a filter that can protect your capital, your career, and your peace of mind from the most destructive force in the modern world: needless complexity. This isn't just a collection of folksy anecdotes about a famous investor. It is a blueprint for achieving mental clarity. It is the understanding that what you avoid, what you say no to, is often far more important than what you say yes to. You now possess the framework to define your circle of competence, to insist on intelligible business models, to communicate with radical clarity, to reject financial alchemy, and to reason from first principles. This is the defensive shield that Warren Buffett has used for over half a century to guard against folly, fraud, and the madness of crowds. But a shield, no matter how strong, is only one half of the equation. Buffett's system is a network of interconnected mental models. The principles of simplicity we have just explored form his impenetrable defense. They tell him which 99% of opportunities to ignore. They keep him safe. But that raises a crucial strategic question. Once you have cleared away all the noise, once you have filtered out all the complexity and nonsense, how do you identify the 1% of opportunities that are truly extraordinary? The principles of simplicity tell you how to avoid the minefields. But where is the map to the gold mines? That is the missing link. That is the other half of the mental arsenal. The video that is now on your screen is that next piece of the map. It is the bridge from defense to offense. It is the link that connects the discipline of avoidance to the art of selection. What we have built today is the foundation, but the skyscraper of true financial freedom requires the next set of blueprints. Most people will stop here, content with their new shield, satisfied with simply avoiding mistakes. But the truly committed, those who are serious about not just preserving wealth but building it, understand that you need both. The choice to click is not a choice to watch another video. It is a choice to continue your ascent, to complete your arsenal. The journey to mastering reality continues, but only if you decide to take the next crucial step.